You know, the market does not defeat a man nearly as often as he defeats himself. I learned that lesson the hard way, and if you've been around the tape long enough, you've felt it too. Not because you can't read a chart, not because you don't understand a breakout, but because of a habit, a small, quiet habit, that chips away at your consistency until one day you wonder where your discipline went. Let me tell you something. Plainly, trading success is not built on brilliance. It is built on behavior. And behavior, my friend, is nothing more than habit repeated under pressure. Have you ever noticed how easy it is to follow your plan when the market is slow? When price moves clean and orderly, you feel almost professional. Calm, controlled. But what happens when the market starts to dance a little faster? When volatility picks up and the tape begins to whisper temptation in your ear? Do you still follow your rules then? That's where the habit shows itself. Most traders don't lose because they lack knowledge. They lose because they develop the most dangerous habit in speculation, the habit of acting too quickly. Impatience disguised as opportunity. Impulse dressed up as instinct. I have seen men study charts for years, memorize patterns, learn every indicator under the sun, and still fail. Why? Because when the moment of decision arrived, they did not trade their system. They traded their feelings, and the market has no mercy for feelings. You see, consistency in trading is not about having winning days every day. That's a fairy tale sold to the hopeful. Consistency is about behaving the same way whether you are winning or losing. It is about executing your edge the same way on Monday morning as you do on a stressful Friday afternoon. But there is a habit that quietly ruins this consistency, the habit of interference. Let me ask you, how often do you interfere with a good trade? You enter according to your plan. The setup is clean. The risk is defined. But then the price wiggles a little against you, and suddenly your fingers get nervous. Your mind starts bargaining. Maybe I should tighten the stop. Maybe I should take a small loss now. Maybe the market knows something I don't. And just like that, you have abandoned your own method. I learned long ago that the big money is not made in the buying or the selling. It is made in the waiting. Waiting requires patience, and patience is a habit few traders truly build. Instead, most develop the opposite habit, the need to act. The market moves, and they must respond. Price ticks, and they must adjust. A candle forms, and they must interpret. They are busy, always busy, but rarely productive. Does that sound familiar? Here is the quiet truth: overtrading is not a strategy problem. It is a habit problem. The same is true for early exits, revenge trades, and moving stop losses. These are not technical mistakes. They are behavioral leaks, and leaks destroy consistency. A professional operator, and that is what you must become if you intend to last, treats trading like a business of probabilities. Not a game of excitement, not a test of courage, a business. In business, you do not change your process every time the wind shifts. You follow the system that has proven its edge over many trades, not just one emotional afternoon. But the dangerous habit creeps in quietly. It begins with small exceptions. Just this once, you say, just this one trade, just this small adjustment. And before long, your method is no longer your method. It has become a collection of emotional reactions stitched together with hope. I have watched fortunes disappear that way. The chart itself is honest. Price leaves clues. Accumulation, distribution breakouts, failed moves. The tape speaks clearly to those who listen without ego. But when habit interferes, the trader stops listening to the market and starts listening to his own fears. That is the turning point. Let me ask you something important when you review your losing trades. Are they truly system failures, or are they moments where you abandoned your own rules? Be honest with yourself. The market rewards honesty and punishes self-deception faster than anything I have ever known. Consistency comes from repetition. Repetition comes from discipline. And discipline comes from habits built long before the trade is placed. If your daily routine is sloppy, your trading will be sloppy. If your risk management is optional, your equity curve will eventually show it. If you chase movement instead of waiting for confirmation, the market will educate you. And the tuition is rarely cheap. But here is the encouraging part. Habits can be rebuilt. The same way a trader learns to recognize a proper base or a healthy pullback, he can learn to recognize his own behavioral weaknesses. The key is awareness first, correction second. Professional traders are not emotionless. That's another myth. They simply build habits strong enough to override emotion when it matters most. When the market becomes fast, their process becomes slow. When the crowd becomes excited, they become selective. When price becomes noisy, they return to structure. That is the difference. You do not need more indicators. You do not need another secret pattern. Most traders already know enough to be profitable. What they lack is the consistent execution of what they already understand, and that gap between knowledge and execution is where the dangerous habit lies. The market will always tempt you to act prematurely. It will always offer trades that look almost right. It will always whisper urgency into your ear. Your job is not to respond to every whisper. Your job is to wait for the moments when the odds are clearly in your favor, and then act without hesitation, without interference, and without second guessing your own plan. Because in speculation, the man who cannot control his habits will eventually be controlled by the market. A trader's edge only works when it is executed without emotional edits. I learned that lesson the expensive way, and if you stay in this game long enough, you will either learn it too, or you will fund the men who already have. You see, most traders believe their problem lies in finding the perfect setup. They search endlessly for the cleaner breakout, the sharper indicator, the one pattern that never fails. But the market is not so easily conquered. The truth is quieter than that. Most men already possess an edge of some kind. The trouble begins the moment they start improving it in real time. Let me ask you something. How often do you follow your plan exactly as written? Not almost. Not mostly. Exactly. Because the edge you tested, the edge you studied, the edge that showed positive expectancy, it only exists in its pure form. The moment you begin to adjust it based on fear, hope, or recent memory, you are no longer trading your edge. You are trading your emotions dressed up as logic. And the market has a way of exposing that quickly. I have seen traders do something curious. They will patiently backtest a method across hundreds of charts. They will nod with confidence when the numbers make sense. They will speak about probabilities like seasoned operators. But the very first time the trade moves against them, their fingers begin to itch. Sound familiar? Suddenly the stop feels too far. Suddenly the target feels too ambitious. Suddenly the trade they trusted yesterday now feels uncertain today. That is the emotional edit at work. The market does not care what you felt 5 minutes after entry. It only pays according to the math of your system over a series of trades. But most traders never allow the math to play out. They interrupt the process halfway through, and then they blame the strategy. That is like planting a seed and digging it up every morning to check if it is growing. A real operator understands something critical. Consistency in execution is what gives an edge its power. Without that consistency, even the finest method becomes unreliable. Not because the system failed, but because the trader did. Have you noticed how traders often manage losers differently than winners? When a trade goes against them, fear steps in. They tighten stops too early. They exit before the setup has time to develop. They cut the trade not because the chart invalidated the idea, but because the discomfort became too loud. But when the trade goes in their favor, another emotion appears, greed. Now they hold too long? They ignore exit signals. They begin imagining bigger profits than the system ever promised. In both cases, the edge is being edited. And every emotional edit introduces randomness. Professional speculation is not about being right on every trade. It is about allowing a proven statistical advantage to unfold over many trades without interference. That requires something most traders underestimate: emotional neutrality. You must behave the same way when you are slightly uncomfortable as when you are perfectly calm. That is harder than it sounds, because the market is designed, almost perfectly, to trigger your instincts. Small pullbacks shake confidence. Fast moves create urgency. Choppy ranges create boredom. Each condition invites you to modify your behavior. But the man who builds wealth in speculation is the man who resists that invitation. Let me be plain with you. Your edge has already accounted for losses. It has already accounted for drawdowns. It has already assumed that some trades will look wrong before they become right. So when you step in and prove the trade mid-flight, what are you really doing? You are removing the very conditions that allow the edge to work. I used to think activity was the mark of a serious trader. Watching the tape, adjusting positions, making quick decisions. It all felt productive. But experience taught me that the most profitable decisions are often the quiet ones. The decision to leave a valid trade alone, the decision to respect the stop, the decision to wait for the full pattern to complete. Restraint, not brilliance, separates the consistent operator from the restless amateur. If you study your own history carefully, and I suggest you do, you will likely find that many of your worst results did not come from bad setups. They came from good setups that you managed poorly. That is the fingerprint of emotional editing. The solution is not more analysis, not more indicators, not more screen time. The solution is building the habit of mechanical execution when your system gives the signal. Because in the end, the market does not reward the man who knows the most. It rewards the man who can do the same correct thing over and over again, while his emotions quietly beg him to do something else. Small habit leaks destroy more accounts than bad strategies. I have watched it happen too many times to doubt it. A man can possess a sound method, a reasonable understanding of charts, and a respectable sense of risk, and still bleed his account dry through a handful of quiet, repeated mistakes. The market rarely knocks a trader out with one dramatic blow. More often, it drains him slowly, trade by trade, decision by decision, until the damage is done and the trader cannot quite explain how it happened. Tell me, have you ever reviewed your trades and noticed how the losses did not come from one catastrophic error, but from many small, avoidable slips? That is the nature of habit leaks. You see, in speculation, the large losses usually make the headlines in a trader's mind. The blown account, the oversized position, the reckless gamble. But in my experience, the more dangerous threat is far less dramatic. It is the trader who is almost disciplined. The trader who follows the plan most of the time, because consistency does not collapse all at once. It erodes. One early exit here, one late entry there, one stop move just a little wider. Each decision feels small in the moment, harmless even. But the market keeps a careful ledger, and over time those small leaks compound into very real damage. Have you ever noticed how a tiny crack in a dam does not look serious at first? In trading, habit leaks work the same way. Consider the trader who repeatedly cuts winning trades too quickly. On any single trade, the difference might look minor, a few points left on the table. But over 50 or 100 trades, the expectancy of the system begins to shrink. The edge becomes thinner, the margin for error disappears, and the trader wonders why the account is no longer growing. Or think about the operator who occasionally moves a stop loss. Not every time, just when the trade looks like it might come back. It feels reasonable in the moment, logical even. But each time the stop is moved beyond the original risk plan, the trader is quietly rewriting the math of his system. Do that often enough, and even a strong strategy begins to behave like a weak one. The market is brutally efficient at exposing inconsistency. Most traders spend their energy hunting for better entries, sharper indicators, faster confirmations. Very few spend equal energy auditing their habits. Yet habits are what determine whether an edge survives contact with the real market. Let me ask you directly, do you know your most common trading mistake? Not the one that sounds dramatic, the one that happens quietly and repeatedly, because that is usually where the real damage hides. Professional traders are not immune to emotion. They are simply more aware of their own behavioral weak spots. They know where they tend to interfere. They know when impatience creeps in. They know which market conditions tempt them to break their own rules, and most importantly, they build safeguards around those weak points. The amateur, on the other hand, tends to focus outward. He blames the market conditions, the news, the volatility, the unusual price action. Rarely does he suspect that the slow leak might be coming from his own repeated behavior. But the market is a mirror. It reflects back your habits with mathematical precision. If you are sloppy with position sizing, your equity curve will show uneven swings. If you are inconsistent with exits, your winners and losers will appear oddly distorted. If you overtrade during boredom, your commission and small losses will quietly accumulate. Nothing stays hidden for long in this business. One of the most dangerous illusions in trading is the belief that small mistakes do not matter. They matter enormously, because trading is a game of margins. Your edge is often thinner than it appears. A few percentage points of unnecessary loss, repeated consistently, can turn a profitable system into a losing one. Have you considered that possibility in your own trading? The difference between the trader who survives and the trader who disappears is often not intelligence. It is not even strategy. It is the ability to identify and seal these small behavioral leaks before they compound. This requires something most people resist: honest self-observation. You must review your trades not just for chart patterns, but for behavioral patterns. When did you hesitate? When did you interfere? When did you act without a signal? These moments matter more than finding the next perfect setup. Because once a habit leak becomes routine, it begins to feel normal. And what feels normal rarely gets corrected. The market rewards precision, but it punishes carelessness slowly enough that many traders never connect the cause to the effect. They simply notice that their account no longer grows the way it once did. Most losses come from breaking rules, not from the rules themselves. I learned that truth sitting in front of the tape long before most traders ever consider it. The market does not demand perfection from you. It demands consistency. And yet, time and again, the trader writes a solid plan, and then quietly abandons it the moment pressure appears. Let me ask you something plainly. When you lose money, is it truly because your system failed, or because you failed your system? Be honest now, because the answer to that question explains more about your trading future than any indicator ever will. You see, a well-tested method already includes losing trades. Losses are part of the mathematics. They are not evidence that the rules are broken, but the amateur trader sees a losing trade and immediately suspects the system. Doubt creeps in, confidence wavers, and that is when the rule breaking begins. Maybe you skip the next valid setup because the last one lost. Maybe you take a trade early because you don't want to miss the move. Maybe you widen the stop because the price is, probably, going to come back. Each of these moments feels small, reasonable, even intelligent in the heat of the moment. But what is really happening is far more dangerous. You are replacing a proven process with emotional improvisation, and improvisation has no statistical edge. I have watched traders spend months building a structured plan, only to treat it like a suggestion once real money is on the line. On paper, they are disciplined. In simulation, they are patient. But when the market begins to move and the position is live, the old instincts return. Fear shortens winners. Hope enlarges losers. Impatience creates extra trades that were never part of the plan. Tell me, how can any system produce consistent results if the operator keeps changing the rules midstream? It cannot. The market is already uncertain enough. Your job as a trader is not to add more uncertainty through inconsistent behavior. Your job is to remove as much randomness as possible from your own decision-making. Professional operators understand this deeply. They know that their rules are designed to play out over a series of trades, not to guarantee comfort on any single one. They expect some trades to feel uncomfortable. They expect some drawdowns. They expect the system to look imperfect in the short term. But the amateur trader wants every trade to feel right, and that desire, that need for immediate reassurance, is what leads to rule breaking. Have you noticed how rule breaking often begins during emotional moments? After a losing streak, after a big missed move, after a frustrating choppy market. In those moments, the trader feels an urge to fix something, to adjust, to take control. But the market rarely rewards that kind of reaction. More often, it punishes the trader for abandoning the very structure that was meant to protect him. Your rules are not there to make you feel comfortable. They are there to keep you profitable over time. There is a difference. Consider the trader who moves his stop loss because the trade is close to invalidation. In the moment, it feels like intelligent trade management. But what has he really done? He has increased his risk beyond the original plan. He has changed the risk-reward profile of the system. And he has done it based on emotion, not data. Repeat that behavior often enough, and even a strong edge begins to erode. Or think about the trader who skips valid setups after 2 losses in a row. The system may call for the next trade. The chart may be clean. The probabilities may still be favorable. But fear steps in and says, wait, that hesitation may feel safe. But in probability-based trading, missing valid trades can be just as damaging as taking bad ones, because the edge only reveals itself across a full sample size. Break the sequence, and you distort the results. Let me ask you something important. Do you trust your rules when they are uncomfortable? That is the real test. Anyone can follow a system when it is winning. Discipline feels easy when profits are flowing. But the professional proves himself during the dull periods, the choppy markets, the frustrating streaks where nothing seems to work cleanly. That is where rule integrity matters most. Because the market is always testing your patience, always testing your confidence, always probing for emotional weakness. And the moment you start bending your rules to relieve short-term discomfort, you begin drifting away from the very behavior that produces long-term consistency. Most traders never notice when the drift begins. It starts subtly. A small exception here, a slightly early entry there, a stop move just once. Nothing dramatic, nothing that feels like a major violation. But trading is a game of accumulated behavior. Small rule breaks, repeated over time, create large statistical damage. The disciplined trader understands something the crowd often misses. The goal is not to avoid losing trades. The goal is to execute the plan cleanly enough that the edge has room to work, because when the rules are followed precisely, the math can unfold naturally. Long-term wealth in trading comes from controlled behavior, not frequent action. I learned early that the market does not pay you for how busy you look. It pays you for how well you wait, and how precisely you act when the time finally comes. Most traders enter this business with the wrong picture in mind. They imagine constant movement, constant decisions, constant opportunity. They believe success must look active, busy screens, rapid trades, quick reactions. It feels productive, doesn't it? But let me ask you, if activity alone created wealth, would the most restless traders not already be the richest men in the market? The truth is quieter than that. The market rewards selectivity. It rewards patience. It rewards the operator who can sit still while others feel the urge to press buttons, simply to relieve the tension of waiting. Controlled behavior means you are not reacting to every tick. You are not chasing every candle. You are not confusing motion with opportunity. You are waiting for your edge. And that waiting is where most traders begin to struggle, because the human mind is not naturally built for disciplined inactivity. When price moves and you are not in the trade, it feels like you are being left behind. When others are posting wins and you are sitting in cash, it feels like you are missing out. The pressure builds quietly. Have you felt that pressure before? That subtle voice that says, just take this one. It looks close enough. That is where frequent action begins to replace controlled behavior. Now understand something clearly: the market offers endless trades, but only a small fraction of them offer real opportunity with favorable odds. The professional knows this. The amateur senses movement and calls it opportunity. There is a difference. Controlled behavior in trading begins long before the order is placed. It begins in how you prepare, how you filter setups, how you define risk, and how you respond when the market does not present your conditions. The disciplined trader has already decided what he will not trade. Most traders skip that part entirely. They focus on what to trade, but they never clearly define what to ignore. And because of that, they remain constantly exposed to marginal setups, trades that look acceptable but do not truly meet the standard of their edge. Over time, those marginal trades quietly drain the account. Let me ask you something important. When you review your losing trades, how many of them were truly A-quality setups, and how many were trades you almost liked? That word, almost, has destroyed many promising traders. You see, wealth in speculation is built on asymmetric opportunity, moments where the risk is clearly defined and the potential reward justifies the exposure. Those moments do not appear every hour. Sometimes they do not appear every day. The trader who understands this becomes comfortable with inactivity, but the trader who equates action with progress begins to manufacture trades. He lowers his standards slightly. He enters a little earlier. He sizes a little larger. He convinces himself the setup is good enough. And slowly, without realizing it, he moves further away from controlled behavior and deeper into reactive trading. The market is very efficient at punishing that shift. Controlled behavior also shows itself after the trade is placed. Many traders think the discipline ends at entry. In reality, the real test often begins there. Can you hold the trade according to plan when the price wobbles? Can you respect your stop when the loss becomes uncomfortable? Can you take profits where your system says to take them, not where your emotions feel satisfied? These are behavioral questions, not analytical ones. I have known traders who could read charts beautifully, but could not sit still once money was on the line. They were brilliant at spotting opportunity, but poor at managing themselves. And in speculation, self-management is the final filter between knowledge and results. Frequent action often feels safer in the moment because it gives the illusion of control. You are doing something, responding, adjusting, participating, but the market does not reward participation. It rewards precision applied at the right time. There is a rhythm to profitable trading. Periods of waiting, brief moments of action, then waiting again. The amateur tries to compress this rhythm into constant motion. The professional respects the natural pacing of opportunity. Over time, the difference becomes very expensive. Wealth compounds when losses are controlled and quality trades are allowed to play out fully. That requires emotional steadiness more than intellectual brilliance. It requires the ability to remain patient when nothing is happening and remain disciplined when everything feels urgent. Most traders underestimate how rare true opportunity really is. They see movement and assume significance. They see volatility and assume potential. But the seasoned operator knows that the market spends much of its time in noise, in transition, in conditions where the odds are simply not favorable enough to justify risk.